But Governor, firstly, thanks very much for taking time out to speak to ET now. Now, you seem to have suggested very strongly in the credit policy review yesterday that yesterday's rate hike may have possibly been the last. Is that a safe assumption to make?
First of all, George, I want to say that it's my pleasure to be on ET now. I value this opportunity. About the question that you asked, whether it's a safe assumption to make, I would think that it's a fairly safe assumption. But what we've given is guidance. And that guidance is conditional on the caveats that we mentioned. What I've noticed in the media coverage and in the questions that I've been asked is that a lot of people are misinterpreting the guidance for an irrevocable commitment. That will be misleading and mistaken. We've said that on our assessment of the uncertainties in the external situation and on our assessment of the domestic developments, the probability of further rate hike in December is low, okay? But that's subject to those conditions.
Governor, you mentioned in your macroeconomic review put out on Monday that the past monetary actions are still unfolding. So while deciding on the rate action that we saw yesterday, was a pause something that you ever considered?
Oh yes, certainly. Because a lot of people suggested that we pause and then say that we will be on vigil. That was one alternative. The other is what we'd actually done, which is to hike and give guidance about future action. Between the two, we thought that what we did was better, and I'll tell you why. If we paused and said that we are on vigil and we might hike once again, there would have been continued uncertainty for investors about when RBI might act further. So the positive impact that we were expecting from a pause would not have come out. On the other hand, we'd hiked because we thought a further hike was necessary, and we'd given guidance which I expect will give greater certainty to potential investors. So between the two, this was a better alternative. So to answer your question, a pause was an alternative considered, but we decided to do what we did.
Sure. Now, on the subject of inflation, you said that despite the recent moderation, commodity prices still remain high. Also that food price inflation is going to remain under pressure. Now, still within that context, you've maintained that you expect inflation to come down to 7% by March 2012. Is that being a little optimistic?
Well, we consider the dynamics of both the commodity price movements and food inflation. If you take commodity prices, of course there has been some increase than a moderation in the last few months. We've taken that into account. And also, you must recognize that emerging economies are slowing down. So the demand for oil would be less. On the other hand, supply might improve. So the outlook on commodity prices is better than it was a few months ago. On the food situation, there are structural factors and there are transient factors or crop cycle factors. The Kharif crop is going to be good and that itself should have some favorable impact on food prices. Of course, we must acknowledge that food prices are driven not so much by cereals but by protein items. In that too, I'm hoping and I'm expecting that the supply response will come in. So taking this into account, we believe that a 7% inflation projection for March 2012 is quite realistic.
So now 7%, Governor, the number that the markets have begun focusing on. They are expecting that going by your guidance, 7% is a number they can look forward to by March 2012. You also yourself said that from there you expect it to progressively decline. But just going back to these 2 points we talked about, the fact that food price inflation remains high, the scare over commodity prices likely climbing once again. Should we expect that going forward we need to come to terms with inflation settling at a new normal, possibly the 6% level?
I wouldn't think so. I think it's too premature to say that. Certainly 7% is above anyone's reckoning of what is an acceptable inflation rate, and certainly beyond the Reserve Bank's target zone. There is an assessment of a threshold inflation That's been talked about in a different context, of course, about what is the threshold inflation that you can accept, above which it will be inimical to growth, below which you can factor that in even as you're growing. That threshold inflation is in the range of 4 to 6%. So I think we'll have to bring inflation down to that range on a credible, discernible, and sustainable basis. And that should be both our goal and our aspiration.
So now, in your downward revision of GDP from 8% to 7.6%, what are the biggest headwinds that you see to growth?
First of all is the external situation. As we said, that is uncertain. And if there is a greater shock from the external situation than we now expect, then that's one headwind. The second will be commodity prices, which again will depend on the external situation. The third will be the fiscal situation. There is talk about the government conforming to the fiscal deficit indication of the budget or slipping from that, and that will certainly have an impact both for growth and for inflation. And by far the most important, I think, will be the reversal in the investment sentiment. That's turned down, as we know, for a number of reasons, and the high interest rate is only one of the many variables that has influenced the decline in investment sentiment. That's got to turn around, and both the government is trying, we've given guidance, and I'm hoping that together that will contribute to this turnaround.
Now, in the same context, over the last 3 months, from the July credit policy review to now, we've seen a fair amount of deterioration in the investment environment and industry in general. Still, you've maintained your non-food credit growth forecast at 18%. Why is that?
Yeah, the projection is 18%. Currently, non-food credit is growing at 19.3%. That's some mid-October number, October 21 number. So it's above the projection. You have to recognize that there is some credit demand for ongoing projects. There's going to be higher credit demand from working capital because the value of inventories will go up. There's going to be higher credit demand because of the inventory to sales ratio going up. You've got to factor all this in your estimate of non-food credit growth. So 18%, I don't think, you probably implied that it is inflationary, but I think that's consistent with our projections of inflation and with our projections of growth.